هذه الندوة بعنوان أزمة السوق الصيني، ثلاث تساؤلات للمستثمرين الخليجيين. طبعا هذه الندوة هي استكمال لرغبة الجمعية بتقديم كل ما هو جديد ومفيد للسادة أعضاء الجمعية ولأفراد المجتمع من المهتمين بالقضايا الاقتصادية ومن المهتمين ببيئة المال والأعمال والاستثمار سواء كانت محلية أو إقليمية. طبعا احنا كلنا شفنا اللي حصل في السوق الصيني من شهر 6 2015 والانخفاض الكبير اللي انخفض السوق، حيث فقد السوق أكثر من 45% من قيمته، وهو بذلك يكون قد مسح كل المكاسب اللي حققها السوق خلال 12 شهر، إلى أن وصلنا إلى تاريخ 24/8 وهو كان يوم الاثنين، حيث سمي بالاثنين الأسود بلاك ماندي، لأن السوق ومؤشر السوق خسر في يوم واحد أكثر من 8%، مما أثار الذعر والتخبط عند الحكومة الصينية وحتى عند المستثمرين حول العالم. طبعا هذا الانهيار يثير العديد من التساؤلات اللي تهمنا احنا، التساؤلات الخاصة بالكويتيين والخليجيين. أول تساؤل: ما هي أسباب هذا الانهيار في السوق؟ وهو موضوع ندوتنا إن شاء الله واللي راح يجاوب عليه ضيفنا. وهذا التساؤل يقودنا إلى تساؤل آخر: هل يعد هذا الانخفاض مجرد هبوط مؤقت أم جرس إنذار لشيء أكبر في المستقبل؟ وهذا التساؤل يقودنا إلى التساؤل الأهم: ما هي تداعيات هذا الانخفاض على الاقتصاد الكويتي وعلى الاقتصاد العالمي؟ كل هذه الأسئلة سيقوم بالإجابة عنها ضيفنا اليوم السيد راغو، هو نائب الرئيس التنفيذي لشركة المركز المالي ورئيس قسم الأبحاث، وهو المدير العام لشركة مختصة بأبحاث المينا ريجن، وهو حاصل على شهادة CFA. Welcome, Mr. Ragu. You can start.
Assalamu alaikum and good evening to all of you. I thank the Kuwait Economic Society for providing this great opportunity as usual to come and share our thoughts about what's going on in the world with respect to China. We have titled this as the Chinese crisis and how it's going to impact, or how to read the situation with respect to GCC. So this is what we are going to be talking about. First and foremost, we'll try to spend a little bit of time to understand what this crisis is all about. How do we understand this crisis? And more importantly, I would like to ask a question as to why the Chinese stock market fall should create such a global consequence. What is really driving this panic all over the world? I think that would be a very good question to ask. The second question is probably what would be its impact on the oil and the GCC economy and the stock markets. And finally, I would also like to see in this obsession with China and its problems, are we missing out on something which we need to focus more importantly than what we are seeing now. Okay, so this is basically how I'm going to be structuring my presentation, and let's take it up one by one. Let's start with the big picture of where the problem is coming from. The big picture is about global growth. We all need the global growth. It has to come from somewhere. And the three main pockets of global growth has been North America, driven by US, Europe, the second one, and the third one is Asia. Now, we know that we all slipped into the master of all crisis in 2008, and US has been struggling to really come to its feet, though I would say that it has been managing that process very well, but not to the extent of how US has been contributing to global growth before. Europe is totally flat and down in terms of economic growth, and its contribution to global growth is practically not that much. And finally, that leaves Asia. As you can see in this chart, the dominant component of Asia is China. And for 2015, we are talking about a global growth of 3.3%, out of which US is expected to contribute 2.5, Europe 1.5, and nearly 4.2% is coming from emerging markets. And if you look at China, China is projected to grow at 6.8%. Now, so you can see how important China is in the game of global growth. And if something were to go wrong in this estimate, everything will go wrong. And we are going to see now what can go wrong as we go along. What happened to China on 24th August? On 24th August, it encountered a massive fall of nearly 9%. A one-day fall of 9% in the stock market is considered a black swan event. It's not a normal movement. So, if you see prior to how Chinese stock market has been building up, right from 2014, it has been peaking at a ferocious pace of about 155% growth in the stock index in a very small span of time. And the reason being that the retail investors have had access to easy money from the banking system, which they use to really participate in the stock market. A very typical scenario for an emerging market where money is made available cheap and easy. It attracted all types of people to the stock market. Everyone went and bought whatever is available at whatever price, no regard to fundamentals. It's all speculation, speculation, and speculation. And that's the story of 155%. And when markets are growing only purely based on speculation, at some point of time, it will give way. And the best point of time to give way is when smart investors exit the market, because they know that this is not a market based on fundamentals. So institutional investors, smart investors exited the market, and along with that, the panic spread to retail investors who have leveraged their positions, and they were, as markets start falling, they have to sell to cover their loans, and as it falls more, the margin call becomes more, and it's a negative feedback loop that small investors get caught, and that explains the rise and the fall of the Chinese stock market. Having said that, I must say that for 2015, China continues to be one of the best stock markets on a YTD basis. On a YTD basis, if you look at the rise and the fall, Chinese market is down by only 2%. The emerging markets are down by 16%. The Indian markets are down by 7%. The American markets are down by 6%. So when you benchmark China with any markets in the world, China is still a better performing stock market. But it is the speed with which it went up and the speed with which it came down that caused the panic among the market participants. Look at what happened, what is now called as the Black Monday. On Black Monday, Chinese market fell by nearly 3.6%, and the next best or worst fall on that day was oil, followed by Saudi Arabia, and then you can see how all the contagion spread. But on the right side are the 3 or 4 GCC markets with the least fall and impact on that particular day, which is very interesting to note. Except Saudi Arabia, all the markets rather withstood the shock much better, though oil was taking away on that particular day. Now, I'll quickly move on to the dominant role of China. Now, this is very important to understand. Back in 1995, the Chinese share of global GDP is only 2%, and today the Chinese share of global GDP, as you can see in this chart, is about 15%, 12 to 15%. Now the pie has increased a lot, and it is going to increase much more as we go into the future. So Chinese share of GDP has grown very significantly. And Chinese contribution to global growth, as you can see with the red color here on the graph, has been consistently growing over time. It is one of the major contributors of growth, and it is one of the largest share of the global economy. So if you combine these two factors and add to that the Chinese are one of the biggest consumers of commodities in the world today. Now, for example, if you look at copper consumption, you can see that nearly 3/4 of total copper consumption in the world is by China. And if you look at the iron ore imports, again China imports the most. Now this is where some connect with commodity-oriented emerging markets come into play. Those countries that export these commodities to China will be hurt immediately and directly with the fall in Chinese. Other linkages are not as strong as the commodity linkage that we are seeing here. In summary, before we go into the picture that is more closer to our heart, which is oil and GCC, I would like to say that this Chinese problem is because the world has begun to depend on China for its growth significantly over a period of time. And second important thing is that there is a bit of an economic explanation that I have to give here. For a decade or more, China has been growing at the rate of 10 to 12%. Now, how is such a high rate of growth possible in the first place? That is because China's model of growth is one of investment-led export model. So you attract foreign investment into the country, you build capacities, you manufacture, and you export to the world. So Chinese market is not China alone, it's the entire world. So it is possible for China to create or manage such high growth rates for a very long time if the world is the market. And it did so because the world needed whatever Chinese produced because they produced very efficiently and very cheaply, and they flooded emerging markets, they flooded developed markets, they flooded across all sectors that you can imagine. So when the world becomes your market, there is no limit to how much you can grow. But there is a catch here. The catch is the party will last as long as exports are strong. And we measure the export by the trade. And trade is nothing but a combination of exports plus imports. For every export, there is an import. For every exporter, there is an importer. So if you add together these two, you get the trade. And if you look at the trade data, for the last 4 or 5 years, especially since 2008, the trade data has been coming down. So the overall volume of business done in terms of exports and imports have come down significantly, and that's what has put a hole into the Chinese model of growth. Now, is this Chinese model of growth something very new? Absolutely not. Japan did this before, Germany did this before, and Russia did this before. And what is the case study about all these three countries? All these three countries went into a big phase of the last decade of no growth after growing frantically through exports. So China knows the problem that it is getting into. Depending on exports alone for its growth is a bad strategy. So it started moving its lever back to its home through consumption. Now, if you look at US as an economic model, US model is predominantly a consumption-driven model. Indian model is predominantly a consumption-driven model. That's why whenever there is a global impact, India does not get as much affected as other markets which are globally connected through exports. So, when you want to change the course from an investment-led export model, which is failing, into a consumption-led growth model, it's not easy. It's like moving an elephant. It's hard and it takes time. And there are two ways to do this shift, either the orderly way or the disorderly way. And it is the disorderly way that we call as the hard landing. Okay, now, economists and experts have been arguing about this hard landing for the last 4 or 5 years. Some camps were saying, no, Chinese will definitely do it in a very orderly fashion, they want to disturb the markets, and in about 10 years' time you can find China producing growth through services and consumption rather than through exports. And then there is a camp that says, no, it is definitely going to be chaotic and very bumpy at every step of the way before this economy starts moving internally to consumption. Now, the evidence that the hard landing is more possible than a soft landing has been coming forth. And this is probably the trigger for the global panic that we talked about. So, if it was just Chinese stock market, there is nothing great about Chinese stock market. Chinese stock market is very much Chinese. It's all Chinese companies are listed. It's all Chinese investors. So there is absolutely no need for the world to panic. The world is panicking because it is expecting China to move into a consumption model in a very disorderly manner than an orderly manner. So that takes us to an interesting question. I want to reflect a bit on how the world was before 2008 and how the world is now in 2015. There are important things that we can look at. For example, before 2008, the US dollar normally appreciates only in times of crisis, when money flows back into US as a safe haven. Now, the US dollar is strengthening not because of any crisis, but because of interest rates. If you look at the role of central banks, before 2008, they were very selective about how they played their cards. Central banks don't jump in every day with some measure. They jump in only in times of crisis, and they quickly get out as soon as things normalize. This is typically how central banks should be. But post 2008, in 2015, you can see that almost all central banks in the world are extremely active players in the market by themselves. Either they are initiating a QE program, or they are reducing rates, or they are increasing rates. If you are a financial fund manager, you have to understand central bank governors' mind more than the market. They have started playing a very active role today, as unlike before, where they only pitched in whenever there was trouble. If you look at economic growth, before 2008, we were talking about 5 to 6% growth globally, and about 7 to 8% growth for emerging markets. It was a robust economic growth scenario. Today, in 2015, we are struggling to grow. The best evidence of that is IMF. IMF today revises its growth numbers every quarter on the downside. So it's going to be a very challenging time. The interest rates before 2008, the Fed rate was 5%, and today it is 0.25%. It can only go to 0%, and after that they don't have any other tool. Before 2008, the world was worried about inflation, how to contain inflation. Today, the world is worried about deflation and how to fight deflation. The reason why Fed is not increasing interest rates is because it's not getting the inflation that it wants. And finally, oil. You all know that before 2008, oil was in a much better band and territory. But today, everybody is talking about a $40 to $50 oil price as the new normal. Nobody is expecting oil to go back to 100. On the contrary, there is a fear that it will slip down to 20. So that is the narrative that is going on when it comes to oil. Having explained the Chinese situation, I will now get into GCC per se and shift the discussion more towards oil, which is closer to our heart in the region actually. Now oil, here is a very interesting chart, I think that dates back to 1861, and it goes all the way to 2014. Now why do I have to see this chart? Simply because oil as part of their broader commodity basket goes through what they call as super cycles. What I mean by super cycle is period of bull and period of bears alternating. But strangely, oil, if you look at the oil price, the red marks that you see in the graph are periods when there is a bull market, and the black marks are the period when there is a bear market. Now, as you can see, the first bull market lasted 3 years, and followed by a bear market that lasted 28 years. And then a bull market came in that lasted 3 years, followed by a bear market that lasted 20 years. And then came a bull market that lasted 5 years, followed by a bear market that lasted 11 years. So, in all, if you see, the bear markets are much larger than the bull market, when it comes to oil. And the average time that people use this chart to explain the length of the bear market, going by the 100-year history of oil, is nothing less than 13 years. And current bear market that you see towards the right-hand corner is only 3 years old. So, and the average price during this period is about $54. But when you are caught in a commodity super cycle on the downside, the drag can be much longer than what we anticipate. So this is the point that I'm trying to make out of this. As we know that oil entered into a downward spiral sometime back, and it gave way about 62% from the peak. And today you can see that it is getting into a volatile range of up and down, but between the range of about $40 to $60 as a band. So the band is established, it just keeps moving between those bands. But how is the long-term performance of the oil price? Here is again another interesting chart that goes way back in history. And if you can see here, the long-term oil price is about $35. And all that is trying to happen in the oil market is coming back to that average, which is, we call this as mean reversion. So what you see as two spikes, in the graph are extremely out of ordinary. From the long-term trend of the oil price, average price adjusted for inflation is about $35, and it is just trying to come down to that level. And what is very important is to understand the oil market, we always look at the demand factors and the supply factors. And the recent Iranian deal is definitely something that oil analysts should watch very carefully. Why? Because if you look at the oil reserves, the largest reserves is in Venezuela, as you can see here as the topmost country with the largest oil reserves, followed by Saudi Arabia, and then you have Canada, followed by Iran. So Iran is the fourth largest country with highest reserves in oil. So if they come back to the market, which is quite possible by what is happening with the Iran deal, they are going to be significant contributors to the supply. And we all know that OPEC has played a great part in the current oil scenario. Let me explain to you how this plays out. In the past, whenever oil came under pressure, OPEC, as a very dominant constituent of the oil industry, always defended the price. When you say defending the price, what you mean is you reduce your production so that the price goes up. So you set yourself a band and you want the price to be there. And the price could be $60, it could be $100, whatever it is, the OPEC defended the price in the past. But now, in the recent episode, OPEC, which is predominantly orchestrated by Saudi Arabia, has completely changed the strategy to defending the market share. So, when you shift your strategy from defending price to defending the market share, you do exactly the opposite. When you are defending the market share, you don't reduce your production, rather you increase your production. And you produce more, you sell more, and you continue to hold your market share, even though net, because of low oil price, your revenues may be lower, but you're not giving up on the market share. Now, why did they do that? That is because of the fear of a new player called shale. Now, shale in the US is a new form of oil that is completely different in variety and in the way you extract and in the way you get it out of the ground. But it has significantly altered the equation of the oil industry. Now, it costs about $70 per barrel to produce a shale oil, and they are considered to be high-cost producers. And when something costs $70 per barrel, and if you have to sell in the market, you have to sell it for more than $70 to be surviving. If you push the price down to say $40, there is no way someone who is incurring $70 will be in the market for long. So the strategy is to drive away high-cost producers from the market, and then the prices will come back to its original level. This is the strategy. Now the question is, that is why I have highlighted and I said it remains to be seen as to whether this strategy is playing off. Now, in all probability it may pay off, but there is also a chance that it may not pay off. Now, coming back to the demand side, as we have seen that China contributes to about 11% of oil consumption. So any slack and slowdown in China is going to be a huge negative for oil and its price, and therefore we have to keep a watch on how Chinese consumption is happening. And to continue the narrative on oil, shale oil, there are two sides of shale explanation that is going around. One is they say that shale will decline, it's only a temporary thing, and you don't have to worry about it. And the other camp is saying that the shale will be very resilient and therefore will grow in its stature and its production. Now, the camps are equally divided because these type of arguments hit the most respected newspapers of the world, which is the Telegraph and the Economist. So the analysts are still very confused about how the shale oil is going to shape up. We have listed down here the arguments of what can really crumble shale players and what can really help shale players. But all I can say is that the arguments are equally divided and there is absolutely no clarity on what impact it will have finally on the end game for the oil producers. We have to also keep a watch on the supply, and as you can see today, OPEC supplies about 30 million barrels per day and the non-OPEC supplies about 54. But OPEC has more leg room compared to the non-OPEC, which doesn't have that leg room. So that is the most important thing to understand. And finally, in the context of GCC, we have to understand the role the break-even oil price plays. Now, what is a break-even oil price? Break-even oil price is nothing but the oil price that a particular country requires to balance its budget. In other words, if the actual oil price is lower than your break-even oil price, you will have deficit. For example, the lowest break-even oil price is that of Norway at about $40, and the second lowest break-even oil price is that of Kuwait at about $54. Now let's take Kuwait for example. What does $54 break-even oil price mean? It means if the actual oil price is lower than $54, then Kuwait's budget will have a deficit. So when it has a deficit, there are two ways to go about it. Either you go back to your reserves and bring the money in, or you go to the market and borrow. Now look at Saudi Arabia, somewhere in the middle. Saudi needs an oil price of about $106 to balance its budget. So any oil price less than $106 will create deficit for Saudi Arabia, which it did already. And Saudis initially started withdrawing from their reserves at a very alarming pace. And once they found that it is a dangerous strategy to do, they shifted gears and they started now implementing a local bond program to the extent of $27 billion. Now, There is nothing wrong about this. The banks have ample liquidity in Saudi Arabia. $27 billion is not a big amount for Saudi economy. And Saudi's debt to GDP ratio is practically nothing. So it is a very sustainable strategy from a management of public finance point of view. But the point that we should note here is that this break-even oil price will only increase, it will not decrease. Why? Because the expenses are always increasing. The expenses are never decreasing. And most of the GCC countries' expenses are two major items. One, subsidies, and another, salaries. And both of them are very difficult to reduce. You can at least stop them from increasing, but you can definitely not reduce them because it will be a very sensitive area to touch upon. And therefore, these governments will either have a break-even oil price that you're looking now, or it will only be increasing as we go from one year to another. As it increases, the gap and the oil price remains the same where it is, the deficit keeps increasing, and then again you're back to either drawing your reserves or you have to issue bonds to manage the problem. Now, outlook for oil price look like so far. Now, so far recently, we have compiled this outlook from all the leading investment banks in the world, like Barclays or ABN AMRO, World Bank, JP Morgan, EIA, and the average call for 2015 is about $58 per barrel, and for 2016 it's about 63. Not very alarming, I would say, still optimistic at that price level, though currently the price is going through some sort of a volatility and test. I think this $63 long-term forecast is rather a decent one. But how is the impact on the stock market for GCC? Now, if you have invested $1 in 2009, this is how it looks like today for all the markets. On top is Dubai with about $2.24. So $1 invested in Dubai is now $2.24. And then you can see the next best performing market is Abu Dhabi, followed by Qatar, followed by Saudi Arabia, Oman, and then Kuwait. Kuwait has been a very lackluster performer when it comes to stock market. As you can see, a $1 invested is only about 75 cents today. And we have reasons as to why that is happening. I just looked at the chart for 2014 and 15, and it looks like most of the months in the stock market are painted in red. So it's a very stressful time for fund managers in the stock market. And you can see that during the last few months, it's been an extraordinarily difficult thing to manage. Now, why this is happening? This is simply happening because earnings is not growing. Now, this chart tells you the earnings story right from 2004, and there are only two periods when earnings registered negative growth, and that was in 2008 when earnings fell by a significant 41% because of the global financial crisis, and the next drop in earnings we are seeing in 2015, which is this year, which is our forecast is that it will drop by about 7%. Now, stock markets are driven by earnings. In the short run, it may be speculation, it may be liquidity, it can be anything. But in the medium term to the long term, a market growth can happen only on the back of earnings growth. So earnings growth is extremely an important metric for us to watch. This will influence the price to earnings ratio. The PE ratio is a very important metric, as you know. The E represents the earnings, which we have seen that there is a pressure on earnings. But the price to earnings ratio for all these markets that we have shown here have now hit the lowest point in their entire history. So which means valuations in the market is at its most attractive best. If you ask me, I've shown here the data for Saudi Arabia, for Qatar, for Dubai, and for Abu Dhabi. These are called a PE band study, where we see the blue line is the current PE ratio, and mostly the blue line is touching the bottom of the chart rather than the top of the chart, which means the valuations are perfectly attractive. To sum up the impact on the oil and the economy and the stock market, I would say that the current pressure on the oil price, falling from a high of about $100 to about $40 to $50, is going to really result, in my view, in lower spending on capital expenditure, which is should be read as project expenditure. Project expenditure is an important feed to the private sector performance, and the government spending is an extremely important component of the economic growth in the GCC. There will be definitely some sort of a pause there as countries watch carefully. There will be a lot of effort now to diversify. We have seen this before. Whenever we enter into a turbulent phase, we initiate reforms for diversification. And sensitive matters like subsidies and expenses will come for a rejig and a revised strategy. We have seen that happening in UAE in terms of attacking the fuel subsidy problem, and we'll see that innovative solutions being offered to contain these subsidies. And finally, you will have to see a lot of reforms coming in place as a direct consequence of this. I wouldn't call low oil price, but definitely low oil price relative to what we have been experiencing in the past. Now, coming to the final section. I mean, the world today, the newspapers are completely obsessed with China. Everyone is talking about China, but I thought that they are missing something much more important than China, which is the Fed rate. Now, why am I getting worried about the Fed rate? If you look at the Fed rate, how it behaved in the past, again, it's a very long-term chart here. The average Fed rate has been 5%. Okay, and today the Fed rate is 0.25%. Now, why is that I'm getting worried about it? It's very simple. The Fed uses the interest rate as a monetary tool to manage a crisis. So whenever there is a crisis, you lower the interest rate, and then if that results in higher GDP, you immediately start increasing it. So the process, I have marked here in red the periods where it lowered the interest rates. Whenever it lowered the interest rates, it is about 12 to 15 months before the interest rates start going back to their average. Now, if you look at the current trend, for example, let me give you, in 1994 when the Fed reduced the interest rates, it remained low for 16 months before it started increasing the Fed rate. In 1997, it was 13 months before it started increasing the rates. In 2004, it was 12 months before it started increasing the rate. And then in 2008, it reduced it to 0.25%. Now it is 80 months and still counting. Now, we haven't witnessed this in the entire financial history. We haven't witnessed this sort of low rate for such a long time in the entire financial history. Now, why did they reduce the rate in the first place? Because they wanted to pick up growth. Now, why is it hesitating to increase the interest rates back to the normal? It's not even starting. The goalpost was June, and then it is shifted to September, now it is shifted to December, and now people are talking about March. So it keeps shifting. You have to start modestly. The 0.25 has to become 0.5, then it has to become 1, then it has to reach to the average of 5. It's a long story. But the start itself is not happening. That is because there is no strong evidence of growth that US has seen. And secondly, inflation is not happening in the US. They need an inflation of at least 2% to get the conviction of increasing the interest rate. The inflation is hovering around 1.5%, and they are endlessly waiting for inflation to catch up before we can do it. Now, why should we be worried about this is because low interest rates, extremely low interest rates, near zero low interest rates will definitely produce cheap money. And money flow is like water flowing in a river. It flows and goes wherever it can find a place. And whenever it goes and flows into a particular area, that is where the bubbles build and then burst. And this is what happened with the subprime crisis. And therefore, this money, cheap leverage is flowing somewhere. We do not know where it is flowing, but it is creating a bubble somewhere. We do not know where it is creating, but it is not definitely the best of best things to do. Monetary policies should be used very wisely, and if it is remaining so low for so long, it will create a much bigger crisis than the Chinese crisis will look very small before that. Thank you, and now I will be happy to take questions.
Thank you, Mr. Raghou. اللي عنده سؤال خير.
Thank you for the presentation. You talked about the growth in China, and you said that it's expected to be lower in the future. And also you spoke about the PA ratio GCC markets. So we are talking about the historical earnings, I guess. How the slowing in the Chinese growth will affect the earning in GCC market? And
let me answer that. The route is primarily through oil. A low growth will definitely suppress oil price, and oil price reduction is, the entire GCC markets are dependent on oil price, and if oil price reduces, the liquidity and the project investments will be lower, and if project investments are lower, corporate earnings will be lower, and if earnings are lower, then your stock market will not do as well. So the primary transfer mechanism of China to GCC happens via the oil price, in my view.
so does that mean a PA ratio still attractive to invest now?
The P ratio is attractive. As I said, the P band, is at its lowest point today for all the markets. But rather than taking a market call on the P ratio, I think it will be a great idea to take, a bottom-up stock picking call on the P ratio. At the macro level, the markets are attractive, but it may remain in a very range-bound manner for a very long time, till you see firm evidence of earnings growth. So till that point of time, it's always a good strategy to play stock picking in times like this, rather than overall market picking based on market valuation. But it's a useful tool to keep your eyes on, to know, whether the markets are in a speculative range or in a fundamental range. When the P ratio is very low, the markets are in a fundamental range. When the P ratio moves up, the market enters into a speculative phase, like how we have seen in China. Yeah.
Thank you, Raghou. I have two questions, if you don't mind. The first one is talking about the KSA reserve and borrowing situations. You mentioned that the KSA started by withdrawing from its reserves and then quickly moved to debt. I did not see it withdrawing from reserves. Could you just shed some light on how much and when it did withdraw from reserve? And in your opinion, is it better to withdraw from reserve or to go down the borrowing route?
You asked a very difficult question.
Shall I save the second one for after?
Yes. Saudi's drawing from reserve is a public news. Okay, since they're all over the place, that they have withdrawn about $100 billion so far from their reserves. And what caused concern is the speed with 400, 100. Yes. And the speed with which those reserves have been drawn caused some sort of consternation, and then they use the next tool that is available, which is to borrow locally. Now, oil exporting countries are today sitting on huge reserves. let's not forget that fact. We are very comfortably placed from a reserves point of view. Oil prices have remained very high for a very long time, and that was an unexpected bonanza for the oil exporting countries. So whether it is Qatar or Saudi Arabia or UAE or Kuwait, everyone had amassed a huge amount of reserves. Now, Saudis' reserves are managed by SAMA, the central bank, unlike Kuwait, where it is managed through Kuwait Investment Authority or Qatar Investment Authority or Abu Dhabi Investment Authority. There is no concept of a sovereign wealth fund in Saudi Arabia. The sovereign wealth is managed by the central bank. And there is this debate in Saudi Arabia as to how to structure the reserves, because it belongs to the future generation. So should the current generation be given the authority to claim on it, or should it be the Norway model where the current authority don't have any access to those reserves and it is meant for future generation. In Kuwait we have a fund for future generations. So this is a larger policy debate on how to use reserves. But countries are free to use reserves, and definitely in times of deficit, the reserves are meant to be used in times of deficit, and that's what they've done. But the beauty of the economic structure in GCC is it is debt free. So unlike Europe, which is loaded in debt up to this, the GCC economies have a huge swath of room, to use in the form of debt. And when you plan to issue debt, first you start locally. I mean, you don't go to a foreign country and issue a foreign currency sovereign debt straight away. You do that only if you have exhausted your local options. And banks in the Gulf countries are always hungry for debt. I mean, if anyone, government issues debt, they'll be very happy to take the debt and keep it in their books till maturity, because they don't have many other instruments to play around with, actually. So, it's not a bad strategy if you ask me whether to issue a debt or to draw on the reserves, as long as you need to do one of the two to really manage your public finances. But in 1998, if you go back in history, when oil prices fell $10 to $10, the Saudis' local debt was very high. And as soon as oil prices started climbing to $20, $30, $40, I clearly remember, I used to work in Riyadh at that point in time. The first thing Saudi government did was to wind down the local debt. So the local debt, I mean, it's not a big problem because it's just transferring from one pocket to another. But still, the Saudis were very conscious about not having any debt when there is really no need. But when there is a need, there is no harm in having debt, and they are at a very low stage of starting. It's not even progressed enough for us to have a debate on this. Actually, it's still a very long way to go when it comes to borrowing. But yes, they are drawn on the reserves.
If I may, the second question. Everybody is talking about China and its effects on the world economy and what's going on. Is it a surprise? Every economist has been talking about China landing hard, soft, and how that for the last 3 to 4 years. So why has the market reacted so aggressively? In your presentation, you talked a great deal about equity market and its reaction and price and PE ratios. What about other classes, namely debt and real assets? What's your view on yields in those two asset classes? Thank you.
Okay, as I said in my presentation, this debate has been going on for some time as to whether it will be a soft landing or a hard landing. But increasingly, these days, more of an evidence is coming towards hard landing than soft landing, and that is causing the concern among the market participants. For example, the PMI index in China has fallen to about 47, and the expectation was about 50. So when you have a very weak manufacturing, and the Chinese devaluation of yuan was seen as a panic reaction to prop up exports. And when markets understood that Chinese are now desperate to really bring their exports back to really maintain the growth. Now someone asked me the other day, what's the big deal? Chinese have been growing at 10%, now they are growing at 7%. Even if they grow at 5%, 5% is still a great number compared to Europe's 0%, right?
We're the second largest economy.
Not really. For the size of Chinese economy with 1.5 billion people on its back, you need a break-even growth rate of 5% to produce jobs. This is the trap that they are in. And the number of new entrants to the labor market requires you to produce a minimum growth of 5%. So anything less than 5% is going to create a huge internal problem for China. And if Chinese start diverting their attention internally, that will be a drag on the global growth. So we are seeing evidences like this now, which increasingly points to Chinese struggling more and more to turn the lever from an investment-led export model to a consumption model. Eventually they will do it because it's a huge opportunity set to be encouraging consumption for 1.5 billion Chinese. You take any product in the world, if Chinese increase their consumption by 0.1%, you have billions of dollars opportunity opening up for you. Eventually it will happen. But what I am saying is that the road to that will be bumpy. And 24th August is just one bump that we have encountered. So as they progress in this street, they will encounter more and more bumps actually, because China has a lot of problems in terms of local banks, because the primary function of financial intermediation is done by state-run banks in China, and state-run banks are notorious for their bad debts. And when these things come to haunt reality, then winding them down in an orderly fashion is not very easy. And there is this shadow banking problem in China that is very high. And the currency issue for China, the export issue for China. So China is expected to manage so many problems in a very orderly manner for the global engine growth to move back to normality. What if that does not happen? Then you will encounter bumps like this that you encounter on 24th August, and that's the worry now. The worry is not that the Chinese will get into a global recession and things like that. Chinese will continue to produce a growth rate of 6% to 7%, which is a good news for the whole world because it's the most dominant contributor of global growth, and it will continue to be a dominant contributor of the global growth, but the ride is going to be bumpy. So market volatility will increase tremendously.
Once the real estate return deal.
Pardon?
Effect on the bond market and the real estate market?
The bond market, is not a very well developed market in emerging markets. If you look at bond markets, they are mostly centered in US and Europe. The investment grade bonds and junk bonds and what have you. Now, bond market, that's another story and another presentation as to what is happening in bond market. But bond market has confounded everyone for the last 10 years. It's been in a bull market, best performing asset class, year after year. And when people say this is the end of the road, no more to go, again it produces another classic year of performance. And therefore nobody has understood the bond market. Bond markets do well when yields come down. And when yields were hovering around 4%, people were saying this is the end of the road. And then yields dived to 3% and produced another bull market in the bond area. And then yields dived down further to 2%. And yields can even go to 1%. And then you will have another bond market rally. And yields can even go to 0%, and then still you will have bond market rally. In Europe, the yields are negative now. You have to pay interest to the bank to keep your money in the bank, okay? And still there is a bond market rally there, in terms of maturity play. So I've never understood bond markets. I'm more of an equity person, but my reading is that the long play of bull run in the bond market is coming to very close to near, but I don't want to take a call on that. Real assets are always tied to interest rates. And it's a function of how the interest rates are going to move. And there are, it's not a direct play like equity, and so it's a bit of a homegrown situation for real assets than a classic global call. For example, the real estate in Kuwait is dependent so much on Kuwait-oriented factors, And the real estate in India, for example, is dependent on how the local markets are served and supplied and what have you. So it's very difficult to take a global call on real assets.
Of course. You discussed the mean reversion and the historical oil prices.
Yes.
And you mentioned that the current rate of the oil prices is the correct one. So based on the historical prices. So are you implying that even if the oil price increase in the future, will it decrease and revert back to the current rate?
No, I'm not saying that the current rate is the correct rate. I wish I know that actually. Nobody knows what is the correct rate. The market determines what the correct rate is. But all I'm saying is that the long-term average oil price is not $100. The long-term average oil price is about $35. But average is average. You have to be very careful dealing with averages. The real world is never at an average level. It's either below average or above average all the time. Okay, so it's not. I mean, it's something that you have to keep a watch on where the oil price is relative to the average. Again, when you talk about average, you can take the average for 100 years, you can take the average for the last 5 years, and you will come up with totally different results. So that's why, an average is a good benchmark to look at, but not something that we should get obsessed with. And that cannot be definitely the indicator for what is the correct oil price. The correct oil price is always dependent on demand and supply, interest. So when world grows much faster, there is a demand and there is an argument for oil price to go up. And the world is inundated with the supply, there is an argument for oil price to come down. So average being average, what really matters is the force with which the demand and supply gets played out. That is more important in my view.
أشكر الجمعية الاقتصادية. I will talk in Arabic.
أنا أترجم لك الحديث. عادي. يمكن يصير عندك رقابة.
أشكر الجمعية الاقتصادية على هذه المحاضرة الجيدة. الحقيقة أنا أعتقد الغرب لعب لعبته بمستوى راقي ومكر. الغرب طلع أخرج سيف ذو حدين بعد وجود اكتشاف الضخم، وجود احتياطات الضخم اللي عندنا احنا كعرب وعند الصين، وحب يضرب الاقتصاد الصيني عن طريق نحن طبعا. فايش صار؟ احنا طبعا بشيء النفط الصخري اللي خرج مفاجأة، وقلنا حتى خبراء البترول يقولون هذا شيء وقتي واكثر دعايه اكثر من هو فعل، يعني نسمع عنه ولا غير ذكي. وفي نفس الوقت الله يسلمك داعش، فاحنا خفنا من داعش وخرجنا السوق بالبترول، والصين خفت طلباتنا من الصين وهم نفس الشيء صار ركه في السوق الصيني. فكل العوامل سيف نجيب سيف ذو الحدين. شكرا. شكرا.
I just want to talk about you talk about everything. You know that we have easing for euro, and we are waiting for Fed rate price. So can we expect that in the future $1 equal €1 in the future? It's not that special. My second question is about this September. Look, people said, especially from last 6 months ahead, we are facing another consent price like 2008. We want just your opinion about these two questions.
Okay, whether euro and dollar will achieve parity, and whether the Fed will increase the interest rates. Okay, these are the two questions. One is a currency question, and another is an interest rate question.
The second
regarding the currency and the interest rate, if I am given an option not to forecast two things in life, and that would be currency and interest rates. And I am very serious about that. I have seen economists consistently failing, in forecasting currency and interest rates. Nobody understood why and how currency behaves, and more so the interest rates. So all we can do at best is to compile, the forecasts of people and see where generally people are looking at in terms of an average. Okay, and that is the best we can do, rather than saying that we expect parity dollar to euro to come in 2016. That would be a very difficult question to answer. Another financial crisis. Crisis is now a part of our DNA, the world DNA. Okay, it's not going to go away. It will come in one form or another from expected places and from unexpected places. The thing is, we should never worry about the risk. We should only worry about how to manage the risk. This is very important. That is why risk management has become a very important function in banks and other companies today. Why? Because risk is here to stay. Otherwise, you wouldn't have a separated department to understand and manage risk. So risk is a very constant theme for everyone, and it will come in the regularity and with increasing force, and we have to, as managers, see and have the checks and balances in place. When will the next crisis come, and how big that crisis will be? I wish I knew the answer.
I have presentation. It's a great presentation, and I appreciate it from the economic point of view. When you look at the numbers, you will not get anything better than that. But when you mix politics with economy, you will see different picture, completely different picture. Whatever is happening now, it's not only about the stock market, the real assets, the real estate market, all of that. It's different switching arms in the international market between the powers, the emerging powers that are coming, like China, like Russia, like Brazil, like India, which came into BRICS, okay, and they started to compete against the United States. It was predicted that the BRIC would be as big as the United States in 2015. They became as big as the United States in 2015. In 2000, it started to predict that China itself, by itself, would be as big as the United States economy, as you showed in your numbers. They became 15%, and the United States controlling 15%. We are very close. So the game is not only about the figures that we see in front of us. It's about the unpredictable policies of the politicians in these countries, which is one of the explanations why, as economists, we cannot predict. We depend on the numbers that we see. This number was reflecting some other strategies and policies of the policy makers, but not the market itself, not 100%. Whatever we saw with the oil price, everybody was saying this is a bubble. Because the oil price to go above $100 per barrel and to reach whatever reached in 2008, 2007, it was a big bubble. And after that, we saw the oil price going down, reaching the normal prices and going up again. Again, it's a bubble. What is behind the bubble? Who is creating the bubble? Who is moving the bubble? You see now the Fed at the lowest for something like, you said something like, how many months? 80 months. Because the power now is playing, or the game is played between the United States and China. They are switching arms, they are attacking. Next, they cannot keep China going like that. So they have to reduce, to help the Chinese economy and to slow down the growth rate of the Chinese economy. They got down with the Russian economy, and they're going after the Chinese economy. And after that, we will go after the Indian economy to slow down this power, raising power in front of the United States.
Sure.
I prefer to mix the numbers with the politics, to read history with the numbers.
Yeah, I agree with that. That discipline is, as you might know, it's called political economy. And I'm representing an investment company, so I cannot talk politics. Number one. And
You have to take your line.
Yeah. Number two, though I realize the importance of politics, but there is always a lot of conspiracy theory, when you go to politics. And, sometimes it may be difficult to substantiate it. It's highly opinionated in terms of who is thinking what and who is doing why. I know a lot of such questions. So I never proclaimed this presentation to be a political economic presentation. It's meant to be an economic presentation, and I would like you to keep it that way for everyone's comfort.
If you allow me another thing, please, we mix between the framework in the GCC and the framework in the world markets. We cannot look for the debt as in the United States and in Europe. We have different economies. We have surplus economies. They will in deficit. I think if they have this accumulated wealth, they will not go to the market for the debt, because it's better for me to liquidate my assets, which is yielding nothing, than to issue bonds or sukuk in the market for something like 4 or 5%. A lot of governments from the GCC, they are putting their money into banks at a rate of something like 25 basis points or 75 basis points at maximum 1.5%. If you issue sukuk or bonds, you will issue this for not at least than 4.5% or 5% to attract the market to come to participate. So we are in a totally different framework, totally different economies. We cannot look at our problem as we look at the nicest problem or Japan problem or Europe and here.
Thank you very much. Definitely, it's not the proper time to talk about the economic development now, because I think the crisis and what is happening also in the market will eat up most of the budgets for development. But do you think with the volatility of prices, oil prices, is it now the right time to start, reinvesting locally in the oil industry, like starting not just selling the oil as a raw material outside, you can manufacture it inside and stuff, be selling probably. This is the right time to think about this as a strategy?
You mean the refineries? And see, that's a very interesting question. Why? Because they are large-scale investments, number one, and they have longer project time cycles. And because of this, it may not exactly coincide with your oil market cycle. So sometimes when the production comes on stream, probably you will have a very low oil price environment, causing difficulty, or you may have a very high oil price environment. So it's not easy to strategize and implement as the cycle moves, because the cycle moves quite fast, and these projects are by nature very time consuming actually. And that's what differentiates the shale oil from the rest, because the shale oil technology is totally different. From finding the reserve to digging and to fracking and to getting the oil, the whole cycle is only about 6 weeks. So it's much easier to strategize there rather than strategize in a conventional oil and refinery sector, where you have to take the charts of a cycle, and you may be lucky to coincide with the cycle. If not, you have to ride it through and wait for the next best cycle to happen.
The oil prices hit the $30 to $35 for 2 or 3 years. How would the equity markets, GCC, react to that, and especially in Saudi Arabia, considering the deficit for 2 or 3 years?
Okay, it's a very curious thing. Stock markets, when oil prices were 100 plus for quite some time, the stock markets did not show any great correlation on the upside. But when oil prices started tanking, the stock markets tanked. So there is a positive correlation on the downside, and there is zero correlation on the upside, as I see the situation now. So when oil prices hit this a level of 20 or 30, which is definitely very discomforting levels, obviously it will have a very negative impact on stock markets, in my view, and therefore it becomes that much more difficult to play the market during such times of low oil prices. Because low oil price means high deficit, and it means government's cautious approach to investments. Rather they would use the money for something that they cannot do away with, and all capital expenditure will come to a halt, and that is the most important feeder for private sector. And the private sector will also start facing the pressure on the earnings, and it feeds also itself actually. So this is definitely an economy where 90% of the revenues are coming from oil. So if that is the case, any good, strong performance of stock market is directly related to a very strong price of oil.
Thanks for the good presentation. I noticed one of the charts that you had included the average oil price historically. So it seemed that we reached a similar peak back in the late 1800s. Now, I don't know how leverage impacts the oil price, and let's say the quantitative easing and derivatives, and so could it be that the peaks are related to heavy liquidity going into the price itself? And secondly, also my second question is the U.S. currently has, I believe, like an export embargo for oil. Like they can't export energy products overseas. Now, could it be that the collapse in oil is not only on the demand side, but also, or let's say the GCC, Kuwait and Russia and other countries are going into long-term contracts with China? Could it be that they're worried that suddenly 2 or 3 years from now, the U.S. will remove that whole block and will suddenly export?
Great questions. On the first question of the impact of leverage on the oil price, I don't see a direct impact of leverage on oil price, because leverage affects pretty much all asset classes and commodities. So it doesn't single out oil. You don't really have an impact. I haven't seen a direct impact of leverage on the oil price. But the second question is very interesting. I don't know, not many people are aware about the fact that the US has an embargo on exports. So this happened in 1970s when oil prices crashed in the 1970 crisis. That's when a law was implemented in US where they prohibited the US players from exporting oil so that they can meet the local demand. Now what happened is that because of which whatever is produced in US has to be consumed in US, and this reduced the price, and they were forced to give this low priced oil to refiners, and refiners were enjoying low feedstock cost, like how SABIC works. Actually, it's pretty much similar in Saudi, in US, and now a larger debate has opened up as to whether we are artificially keeping the prices low in US to the benefit of refiners and not to anybody else. Okay. Now they have started experimenting in a very small way with Mexico, and they are exporting the oil that you extract from shale is light, and it's less on sulfur. So it is something that you can easily export. But the oil that they need, for the refineries are very heavy and on sulfur. So that is the type of oil that they need. So this is what they have bartered with Mexico. So the Mexico is giving them oil that they can use in their local refineries, and in return they are giving oil to Mexico which is of higher quality that they can get. This is a very small experimentation, and if it works well, then it may open up a larger avenue for lifting the ban of exporting oil from US. And if that happens, then it might distort the oil market even more. Today the distortion is less because there is a ban on exports from US. But if that ban is removed, it might definitely impact the global markets. But having said that, I should also tell you that there is a huge gap in US between production and consumption. So they are still nowhere in that excessive zone of exporting. They still import oil, to the extent of not being able to meet through the local production. The gap has narrowed thanks to shale oil, but it has not vanished. And the forecast is this gap will continue to be there for some time to come. So as long as this gap between what is produced and what is consumed or demanded, remains, you don't have an impact even if you lift the ban. But moment this gap vanishes and America becomes self-sufficient in terms of energy, and then it coincides with the lifting of export ban, then you are seeing a competitor to Saudi Arabia in the market. So that is a different oil dynamics that we are talking about, but it will play out eventually. That's a very interesting analytical study on the export ban of the US. There is a very interesting article last week in Economist about this, if you want to read it. So it's very, very telling about the problem.
Thank you, Mr. Raghou, for this information. I don't understand when talking about the strategy of oil producer, when they shifted from old strategy to the new strategy. Does it work for countries adopting this strategy, especially the countries adopting this strategy? They are the main affected by the deficits they are had in the economy. Does it work to adopt it likewise? And when, if you're going to tell me the reason is to get the high producer out of the market, now with the prices below the $50 or 20, in this range that he said, I assume that they are now out of the market. So why to shift again for the old strategy? Is it possible or it's not?
I did not say they're going to shift to the old strategy. What I meant by the new strategy is that when you're trying to defend your market share, the consequence of that will be low oil price, and you are aware about the consequence because you expect that low oil price to drive away high cost producers, and when high cost producers go out of the market, the supply comes down, and when supply comes down, the price goes back. And then you have the old oil market dynamics back in the game, and it may be nice to get to the old price this way. But the assumption here is that the low oil price will put the shale oil producers out of business. Now, this is where I said the evidence is still not clear. Why? Because at the beginning of 2015, I was reading that it takes about $70 to produce shale oil per barrel. Now I'm seeing the number 50. So they are, making huge progress in terms of reducing the cost. So if they are able to manage the cost, and they can stay in the game longer than you expect. And if they stay longer than you expect, this strategy will backfire on us. Okay. So they have taken a gamble, and we have to see how it plays out. So it's still too early to say whether this strategy has played out or not. Maybe I have to wait for a year or so to see. But whether OPEC, led by Saudi Arabia, can withstand that amount of time to play the strategy, definitely yes, because they are sitting on a much larger resource today than in 1998 when oil prices crashed actually. So it's a calculated gamble that they have taken, fully aware of the risks, and we have to see how it plays out actually.
Question please. If this strategy didn't work with shale oil, what about other high-cost producers? I guess Russia and maybe Nigeria and other countries. So does this strategy, will this strategy you think affect them? So they will maybe negotiate with OPEC the reduction of the production together?
Yeah. See, OPEC is not a very homogeneous set of people. You have a lot of players in OPEC that are stressed and are highly dependent on oil price. Yeah. So after some time they may start putting pressure to change the strategy. Okay, because they cannot live with a $40, $50 oil price for a very long time when the break-even oil price is about $150. Okay, so Russia is a classic example, Iran is a classic example, and if you see the other oil players, they may not subscribe to this strategy at all because they want higher oil price, not lower oil price to sustain their budgets actually. And the whole thing is to drive away high-cost producers from the market, and the high-cost producers will include even conventional oil producers as well. They will also go out of business if oil prices stay low for a very long time. So who will survive in the long run of this game would be people who are sitting on huge reserves, which is GCC. So they are the only people who will be capable of surviving on this strategy. But I don't think they can experiment with strategy for a very long time. They have to quickly take some decision after seeing some evidence of this. When, for example, demand may come back. If Chinese start reporting a 7% growth rate consistently for 4 quarters, now oil markets will start going back to 60 and 70, and that will be at least enough cushion for stressed countries, in terms of the cost of production. But the whole argument about the shale gas is that they are highly leveraged and they are borrowed and they are financially stressed, and the junk bond market is infected by shale producers, and therefore if oil prices remain at $40, they'll be soon out of business. But the point is, they may be out of business, but when oil prices again go back to say 80, they can come back to the business, because the way the technology works is that you can close it and come back and open whenever you want. It's not like conventional oil drilling and oil taking technology. It's a completely different technology that is being experimented. So we are talking about various variables. We do not know how all of them come together and nicely play out. But as far as we are concerned, we know that there is a huge shift in strategy from Saudi Arabia, from defending price to defending market share.
Do you think they have another option these days?
They had the original option of defending the price, right?
But
they have done this so many times before, and everybody expects OPEC to do that. And this time around, very surprisingly, they have started defending market share. It is a huge surprise to all the players.
Don't you think the producers always cheat about their share?
There is nothing to cheat now because everybody is encouraged to produce as much as you want.
That's why I think it's the only option for them. If they try to reduce
the earlier model had the cheating component big time. The earlier model of restraining production to increase the price, people agreed and then but they cheated on their quota and produced more than what has been promised actually, but it was never too much. They just hovered around their quota limits a bit, but they generally were keeping it. But now it's a completely different strategy. Now Saudis are pumping 10 million barrels a day. That's the speed with which they are producing it.
إذا تسمحوا لي عندي مداخلة بسيطة بس Mr. Rago, just I want to add one thing. Unlike Saudi Arabia, Kuwaiti law doesn't allow any withdrawal from the reserve. That's why the government is thinking about issuing some bonds, because the law is not like Saudi Arabia. Just I want to add this note for the information.
In fact, it's a great model of a sovereign wealth fund to have. It's a lovely model. And even they titled it as Fund for Future Generation. I think it's really a very appreciable thing as far as Kuwait is concerned.
But we changed the rules.
في أي أسئلة ثانية؟ هني نصل إلى ختام هذه الندوة. Thank you Mr. Rago for your presentation. أسأل الله العلي القدير أن قدرنا نفيد ونستفيد ونخلق قيمة مضافة للجميع. مشكورين على حضوركم ويعطيكم الف عافية.